There are practical moves you can make to effectively recoup the equivalent of 3 extra months of salary every single year. Everyone, today let's talk about how you can safeguard your wealth and secure your future amid sky-high inflation, mounting debt, and an increasingly divided society. What economic landscape are we facing in 2026? The Federal Reserve's latest June economic configurations have revised up the core PCE inflation forecast to 3.3%, up from just 2.7% only 3 months earlier. In his first statement after taking office, Fed Chair Wash laid it out plainly. Inflation is driven by supply shocks hitting specific sectors, including energy. New York Fed President Williams acknowledged last week that inflation is undeniably too high, running at roughly 4% right now. Europe isn't faring any better. The European Central Bank raised its 3 key interest rates by 25 basis points in June, projecting average inflation of 3.0% across 2026. Conflicts in the Middle East are pushing energy prices higher, and those rising costs are trickling into every link: groceries, consumer goods, and services. This isn't just headline news. It shows up in your grocery bills, fuel receipts, and your children's tuition fees. Meanwhile, U.S. household debt has climbed to a record $18.8 trillion. Credit card default rates stand at a 16-year high, with 13.1% of credit card balances severely delinquent, over 90 days past due. Auto loan default rates have hit the highest level on record tracked by the New York Fed. The personal savings rate has tumbled to 2.6%, compared with 5.8% 1 year ago. Folks, this is not a regular business cycle. We are going through a systematic stress test. The federal funds rate is currently held in a range of 3.50% to 3.75%. Yet the dot plot signals the median forecast will rise to 3.75% by the end of 2026. Half of FOMC members expect at least one additional 25 basis point hike this year. The ECB deposit rate has climbed to 2.25%. What does all of this mean for you? Your variable rate debt, credit cards, adjustable rate mortgages, personal loans, is only getting more expensive. So how do we tame inflation, this wealth-devouring beast? Let me speak plainly. Amid high interest rates and rampant inflation, debt is your biggest threat. First, carry out an urgent financial detox. Take action immediately. Stop creating new debt. This is the hardest yet most critical step. Freeze or cancel your credit cards and switch over to debit cards or cash. If your finances are bleeding cash, stopping the outflow must be your very first move. Prioritize paying off high-interest debt. Adopt the debt avalanche method. List out every debt you have, note down outstanding balances and interest rates. Stick to minimum payments on all other liabilities and funnel every spare dollar toward the debt carrying the highest interest rate, almost always credit cards. Mathematically, this strategy saves you the most interest. Average credit card rates sit above 20%. In an inflationary environment, that's effectively predatory lending. Every dollar wasted on interest is a dollar you cannot use to fight inflation. Cut your interest expenses through debt restructuring. Don't be afraid to negotiate with banks. Look for balance transfer credit cards offering 0% APR, or apply for a lower rate personal loan to pay down expensive credit card balances. Consolidate scattered high-interest debts into a single loan with a lower rate and a clear repayment timeline. Next, rethink how you manage your cash. Most people leave cash sitting in traditional big bank savings accounts earning merely 0.62%. Meanwhile, inflation runs above 4%. In real terms, your cash loses more than 3% of purchasing power each year. Shift your funds into high-yield savings accounts or money market accounts. Some now deliver returns near 4%. This isn't about getting rich. This is about stopping wealth erosion. Your emergency fund needs to stay liquid, yet idle cash should never be left to get eaten away by inflation. Stop keeping spare money in zero-interest accounts offered by large legacy retail banks. Move your emergency reserves, normally covering 3 to 6 months of living expenses, into high-yield savings accounts or money market funds. In today's rate environment, they form a risk-free buffer against inflation. Lock in your fixed expenses. If you hold a fixed-rate mortgage, count yourself lucky. It's one of your greatest assets during inflation. You repay future obligations with currency that loses value over time. Never rush to pay it down early, unless you have eliminated all high-interest debt first. In a high-rate era, consumer loans are not a shortcut to a comfortable life. They are a modern financial noose around ordinary households. Average credit card. APRs in Europe and the US are approaching or exceeding 20%. What does that mean? If you carry large credit card balances, you are effectively working for the bank. Under 20% compound interest, there exists no legal investment that can reliably beat a 20% debt cost. If you have variable rate liabilities, consider refinancing to lock in fixed rates right now. Do not bet on rate cuts arriving soon. Fed projections show rates will stay above 3% through 2028. Third, build a genuine emergency fund. Financial experts now recommend expanding emergency savings beyond the traditional 3-month buffer to roughly $20,000. 3 months of reserves are no longer sufficient in 2026. Keep this fund in high-yield vehicles so it can, at minimum, keep pace with inflation. How can regular people preserve wealth amid widening social divergence? You cannot reverse the tide, but you can learn how to swim. As JP Morgan CEO Jamie Dimon put it, we have indeed left lower income groups behind. This is not political rhetoric, it is data-driven reality. In an increasingly stratified society, you cannot rely solely on a salary to maintain your social standing. You need to transition from labor income to asset income. You must become an owner of capital, even if your holdings start small. Steer clear of speculative cryptocurrencies you cannot understand, and avoid frequent short-term stock trading without professional expertise. For everyday investors, regular dollar-cost averaging into broad market index funds, such as S&P 500 ETFs or MSCI Global Index Funds, is the steadiest, lowest-cost way to share in the growth of the world's leading corporations. Sound financial defense requires you to manage liquidity the way institutional investors do. Think about cross-border asset allocation. In a fractured, uncertain world, do not put all your eggs in one basket, even if that basket is the United States. Global diversification hedges against inflation risks as well as geopolitical risks. Aim to participate in markets rather than trying to beat them. The classic 60-40 stock-bond portfolio is losing effectiveness. Data analysis by multiple mainstream investment research teams indicates that no single asset class offers foolproof inflation protection during high inflation periods. Diversification remains the only strategy repeatedly validated by history. You may consider REITs. Historical data shows housing prices and rents can outperform or match inflation over the long haul. You can also build global equity exposure spanning US, international, and emerging markets. Gold and tangible assets are classic inflation hedges. One investment expert put it well. The right question isn't, what is the best inflation hedge? Instead, it is, how do we construct a portfolio prepared for all inflation outcomes? Finally, invest in yourself. This is your one asset no one can take away. In a K-shaped economy, human capital serves as your best insurance. Upgrade your skills, expand your network, and stay professionally competitive. As AI and automation reshape labor markets, lifelong learning is no longer an option. It is essential for survival. Everyone, we live in extraordinary times. The United States is experiencing a K-shaped economy. High-income households keep rising, while low- and middle-income households slip backwards. The richest 1% own roughly half of all corporate stocks and mutual funds, worth $27.64 trillion. The top 10% hold more than 87% of all stock wealth. Meanwhile, the bottom 50% of households hold just $4.27 trillion of the nation's total $174 trillion wealth, a tiny share. Inflation will not vanish overnight. The Fed itself forecasts inflation will not return to its 2% target until 2028. This is no reason to despair. It is a call to act. Debts will not disappear on their own. That $18.8 trillion figure will only keep growing. Social stratification will not fix itself. the two arms of this K-shaped economy will drift further apart. You are not a passive bystander of macroeconomic policy. You take command of your own financial destiny. As a wise person once noted, inflation protection should not be something you hastily add to your portfolio the morning inflation hits the headlines. It starts today. It starts right now.